afternoon, everyone. Hello, my name is Dionne Savage. I have been a practicing attorney for over 19 years. I focus my practice in economic development, tax credits, real estate, corporate transactional work, and I am also the managing partner of Savage & Associates Law Group, a woman-owned and minority-owned law firm dedicated to economic development. I'm licensed in Pennsylvania, New Jersey, New York, and Washington, D.C. I represent clients nationally in tax credit transactions and work collaboratively with clients and attorneys nationwide in areas where I'm not licensed. I have represented government entities, developers, lenders in the New Market Tax Credit Program since the inception of the New Market Tax Credit. So thank you for joining today. I'm delighted to talk about New Market Tax Credits. This webinar is designed to cover New Market Tax Credits, and hopefully we'll have some time left over to talk about Opportunity Zones, which is a new tax credit incentive to help redevelop low-income communities. So let's jump in. What you will learn today. We will discuss New Market Tax Credits and demystify the acronyms of New Market Tax Credits and some of the jargon that may have created problems with understanding how the program works. We'll also understand who the players are in New Market Tax Credits, and we will take a high-level view of a recent New Market Tax Credit and Opportunity Zone transaction that closed in March. Finally, I will help you focus on how your organization best fits within the New Market Tax Credit Program and how you can take advantage of the benefits. Whether you're a government agency, a developer, a bank, or any other entity, there is a role for you in New Market Tax Credits. The New Market Tax Credit Program is a federal tax credit program established by the Community Renewal Tax Relief Act of 2000, Section 45D of the IRS Code, at the tail end of the Clinton administration to spur new investments in communities that have been historically challenged with access to capital. The dollar-for-dollar reduction in tax liability is designed to incentivize investors to make investments in low-income communities. The federal government wanted to give investors more incentives to make their investments in low-income communities as compared to other communities where their returns could have been better. Many low-income communities lag behind other communities. Therefore, the federal government designed this tax credit to further incentivize investors. The New Market Tax Credit Program is administered by the Community Development Financial Institution Fund, the CDFI Fund, a division of the Department of Treasury. The program is a place-based program, which is determined based on the most recent census tract. The CDFI Fund's website at www.cdfifund.gov has a search vehicle where you can insert an address to determine whether the location is within a qualified low-income census tract and whether the census tract is severely distressed. Most community development entities, which we will talk about, that's one of those terms that is New Market Tax Credit jargon, but we will talk about that shortly, desire to do their transactions in severely distressed census tracts. A qualified census tract is where an individual poverty rate is more than 20% of where the median family income is less than 80% of the area median income. Area median income refers to the median income, family income of the state, or if the census tract is in a metropolitan statistical area with a higher median family income than the state as a whole. Another option that can be used as compared to qualifying a project in a census tract is to qualify the project by targeted population, which requires a determination of who the project will benefit. For example, if a food bank program that is not located in a low-income census tract is attempting to qualify for New Market Tax Credit, if the program can demonstrate that it's targeting children and families that qualify for WIC or other food subsidy dollars, then the program could potentially qualify for new market tax credits. So who are some of the players in a new market tax credit transaction? First is the allocatee, which is the entity that basically received an allocation from the CDFI fund. As I mentioned earlier, the CDFI fund is an arm of Treasury, and they administer the new market tax credit program. A CDE, which is a term that you will generally only hear in the new market tax credit area, is a community development entity, which is taxed as a partnership or a corporation. The CDE, and that's what I'll refer to it as we move forward in the presentation, really is the engine of a new market tax credit transaction and is the engine of the new market tax credit program. A QEI, a qualified equity investment, is the investment made into a CDE that triggers the tax credit. The QEI is made by an investor. I'll have a chart that will lay a lot of this out as we move forward. A Qualic B, or a qualified active low-income community business, is the entity that receives the loan or equity investment from the CDE. A qualified low-income community investment is the investment that is made between the investor and the CDE. So if you can imagine, there are multiple levels to a new market tax credit transaction. And I have a chart that'll lay that out a little bit more clearly as we move forward. The interesting thing is when I work on new market tax credit transactions, everyone is happy when we close because everyone is receiving exactly what they came to the transaction for. Many of the key players in new market tax credit transactions, such as the CDE, are generally in the deal because they want to continue their mission of doing good in the community. Some entities, some CDEs, are banks that form a CDE, and others are the equity investor, which is in the transaction for the 39% tax credit over 7 years, and the leverage lender, who is in the transaction for to receive debt payments and also to benefit its CRA requirements. So as you can see, everyone has a benefit in a new market tax credit transaction. The new market tax credit transaction provides a 39% tax credit over 7 years. It's a 7-year compliance period. Investors can receive a 5% tax credit for the first to third years and 6% tax credit for 4 to 7 years. Through the new market tax credit investments, many types of private investment transactions have been financed and funded in low-income communities. The program is designed to fill the gap in financing capital stacks. So if you're looking at putting together a transaction or you're reviewing a developer's capital stack and you notice that the developer has multiple different debt or different types of grants that potentially have been included in their capital stack, but there's still a gap, the new market tax credit program has been a great gap filler and has helped in a variety of different ways. And we'll talk about that a little bit further. I've closed transactions that have ranged from financing a Target department store in Pittsburgh to a soup kitchen, hotels, and even a women and children's shelter. There are certain types of transactions that cannot be financed. For example, 100% residential buildings cannot be financed with new market tax credits. However, mixed-use projects, and those are projects where 20% or more of the gross income is generated by commercial activity at the project. So for example, if there's a Safeway and multiple other inline stores on the first level and apartments above, those types of transactions are considered to be mixed use. They're not 100% residential. 20% of the gross revenue comes from a commercial component. Therefore, it qualifies as non-residential property, which can be considered for new market tax credits. Other transactions or other businesses that cannot be financed, and we refer to them as sin, or other businesses that cannot be financed, and we refer to them as sin businesses. Mainly carry out liquor stores, and there's a further analysis that can be done if the supermarket has or sells alcohol, massage parlors, racetrack, gambling facilities, golf courses, hot tub facilities, suntan facilities, country clubs, and certain types of farming businesses cannot be used with new market tax credits. So let's talk a little bit about what a CDE is. A CDE is basically, as I mentioned before, the entity that really puts the entire transaction together. The interesting thing about a CDE is that it really is not loaning its own money. It's essentially a pass-through of the funds that are invested at the upper portion of the transaction. So as we go through, I want you to think about the terms that we're utilizing, think about what each of the entities are doing, but I'm going to show you a graph that will really help crystallize this a little bit later. The only, like I said before, the only place that you'll hear the CDE term is in the New Market Tax Credit Program. To become a CDE, an entity must be taxed as a partnership or a corporation. The entity that is sponsoring the CDE, for example, if a local bank decides that it wants to form a CDE, it completes a CDE application and submits the CDE application to the CDFI fund for certification. Once the entity is a CDE, it can then apply for new market tax credit allocation. The new market tax credit allocation application process is extremely competitive and takes many entities more than one try at obtaining an allocation. But back to the definition of a CDE. A CDE is a community development entity, and it must use substantially all, so for our purposes, we'll use 85% of the dollars that are invested into the CDE when it makes its loan or equity investment to the Qualic B. So for purposes of our discussion, think of Qualic B as the borrower. Who's the end borrower in the transaction? The community development entity, or CDE, must maintain a primary mission of community development. In addition to that, it must maintain accountability to the residents of low-income communities through its advisory board or its governing board. A few examples in Philadelphia is the Philadelphia Industrial Development Corporation, or PIDC. Here in DC is the DC Housing Authority or City First Bank. Those are a few that you may be familiar with. So what constitutes a qualified low-income community investment, or a QLICI? So a QLICI is a loan or equity investment to the borrower, the Qualic B. It can also be financial counseling or other services to a business or residents in a low-income community, or it can be a loan or equity investment into another CDE. What constitutes or who is a Qualic B? When I say Qualic B, just think of Qualic B as the end business, the business that will receive the loan or equity investment from the CDE. This entity has to be located in a qualified census tract. 50% of the gross income has to be from activity within the low-income community, from the trade or business that it's operating with. 40% of tangible property or services must be performed by employees within the low-income community. If the business does not have employees, then the test is at 85%. The Qualic B cannot have more than 5% of its income in collectibles and no more than 5% of its property in non-qualified financial property. Non-qualified financial property is stocks or other types of different types of property that the entity could hold. Sometimes it can be cash. So it's always an analysis of how much cash the entity has on hand. So we do have a question, and I think the question was whether new market tax credits can be combined with LIHTC. So LIHTC is low-income housing tax credits. And as I mentioned before, new market tax credits has to be used for commercial purposes. So let's talk a little bit about how you can combine the two. So as I mentioned first, new market tax credits is for commercial business transactions, not residential transactions. LIHTC is used for residential transactions. The way that we combine new market tax credits with LIHTC is we create a condo structure where we separate out the commercial component and we separate out the residential component. So for example, the new markets deal could be on the lower level of the building structure, and the residential LIHTC component can be used for the residential portion at the top of the transaction. So I mentioned a mixed-use project previously. The new markets will not allow for the entire project to run through a new market structure, but the Safeway and the inline stores could definitely be its own new market tax credit transaction. And the LIHTC portion of the deal could be the residential portion at the top of the transaction. So one of the big issues in new markets is recapture. So recapture can happen if the CDE ceases to be qualified as a CDE, or the equity investment provides is no longer meeting the substantially all required. Remember, I mentioned the 85% test that is required by the CDE to make sure the CDE has invested 85% into the Qualic B, which is the business. So that has to stay in place for 7 years. So these tests are really critical, and there are a lot of stress points that are done at the beginning of the transaction in order to make sure that many of the tests that both the CDE and the Qualic B / borrower have to comply with are maintained. For the equity investor to receive its 39% tax credit, they want to make sure that all of the new market tax credit requirements are complied with during the 7-year time period. And also they want to make sure that none of the things that could run afoul of those new market tax credit requirements are triggered. So as I mentioned, CDE has to maintain a CDE status, and equity investment has to maintain the substantially all requirement. And the CDE does not want to redeem cash that it does not redeploy. So all of those are recapture events. Now, surprisingly, one of the recapture events is not the actual borrower going out of business or going dark. So when the analysis is done or the underwriting is done on the Qualic B, of course, no one is going into a transaction anticipating that you'll have a problem with your Qualic B. More importantly, we do have certain requirements that we expect for the Qualic B to have gross revenue within 3 years. So there are certain requirements that the Qualic B has to comply with, but one of them is what happens if the Qualic B just doesn't make it as a business venture. That in and of itself does not create a recapturable event for the CDE. There are a few cure opportunities that the CDE has. There's a 6-month cure period to correct a failure of substantially all. So for example, let's look at this as an example. If the CDE brings cash back in to the entity based on some type of activity by the borrower, some problem that the borrower or the Qualic B entity is having, the CDE has an obligation to redeploy or relend those funds depending on where they are in the 7-year period. If we get to year 7, they don't have to redeploy, but year 1 through 6, they do need to redeploy. So here's the structure I was talking about earlier. I have 2 structures that we're going to look at. This is the first one, just to review what we talked about. As I mentioned, if you look in the upper left-hand corner, I guess it's left-hand corner for me, might be right for you, but if you look at the upper left-hand corner, the leverage lender. So the leverage lender makes a loan to the investment fund. So let's just put a pin on who this entity is and the variety of things that we've seen in the new market tax credit program. Early on in the transaction, in doing new market tax credit transactions, even this structure, which we call the leverage financing structure, didn't really exist. It was a more simplified structure. But as we have developed and the new market tax credit program has become a little bit more complex, we actually use this structure of financing based on Revenue Ruling 2003-20. And it allows for the leverage lender to essentially make a loan to the investment fund. And then it further allows for the investor to receive the full amount of the tax credit benefit on all of the dollars that are loaned through to the investment fund. So the leverage lender is in the deal because they want the return of interest and principal. That's the only reason they're in the transaction. Some leverage lenders are in the transaction because they want to benefit with their CRA credits, but for the most part, the leverage lender is in the transaction for the return of the interest and principal on the amount that it has loaned. To complicate this a little bit more, just imagine another box outside of leverage lender. How the new market tax credit program has become more sophisticated, and this leverage lender that makes the loan to the investment fund really is an affiliate of the borrower or an affiliate of the Qualic B. So let's take our example that we used before of who is a CDE. And I mentioned City First Bank. Well, City First Bank could also be a lender to the leverage lender, meaning a lender to the affiliated leverage lender in this transaction. So the Qualic B, which is our borrower at the very low box, is participating in this transaction at two different levels. One as the end borrower and the other as an affiliate to the leverage lender. That's done because at the upper tier, I'm just going to jump to one slide and we're going to jump back. If you look at this transaction, this is an actual new market tax credit opportunity zone transaction that I recently closed. But if you look at the dotted line across that separates the upper tier from the lower tier, you're really looking at two separate transactions that are happening at the same time. So I'm going to jump back to my prior slide. The leverage lender, as an affiliate of the borrower, can get a loan from City First Bank. So City First Bank is making a loan to the leverage lender. That's done because at the upper tier of the structure, the collateral is not the dirt. The collateral is not the end project or the end building. The leverage lender or the investor or the investment fund, none of the entities at the upper tier of this transaction are receiving a mortgage. So in most real estate transactions, the lender is looking for to receive a mortgage based on what they've loaned. But that's not the way that a new market tax credit transaction is structured. And that's one point that lenders that work in the new market tax credit area have to become very comfortable with. As I mentioned before, the CDE, which is the triangle in the middle, is the engine that makes this whole transaction go. So the CDE is really the conduit lender in the transaction. They loan to the Qualic B / borrower. The CDE is the entity that has a mortgage on the property. So let's go back up to the leverage lender. The leverage lender receives a loan from City First Bank. The leverage lender is an affiliate of the Qualic B. The leverage lender loans those dollars to the investment fund. On the other side of the model is the investor. The investor makes an makes an investment, puts cash into the investment fund. The investor is in the transaction because they want the 39% tax credit. So the types of investors that we've seen can typically be banks, Wells Fargo, US Bank, or large investors that are looking for the 39% tax credit over 7 years. The investor makes an investment into the investment fund, and the investment fund takes the leverage lender's dollars and its own dollars from its investor, and it makes an equity investment into the CDE. So if you see the arrow that points down from the investment fund, it makes an investment into the CDE, and it then becomes a partner in the CDE entity. So by just virtue of pure tax law and corporate transaction law, based on the investment fund being a partner in the CDE, it will receive a return. That return is really how the tax credit is returned back to the investor. So the CDE and the CDE affiliate, which I think we gave an example of, if City First forms a CDE and City First operates as the sponsor entity, then City First could operate as the allocatee, the entity that received the allocation, and then sub-allocate that to the CDE in the middle that's actually the engine in the transaction. Many allocatees that receive an allocation of New Market Tax Credit Authority, they form multiple CDE entities. So they form multiple special purpose entities, and they use a separate and different CDE for each transaction. So if you close a transaction, you don't want to use the same CDE because there could be a recapture, it could be many different issues that happen. So from deal to deal, the allocatee will form a new CDE and run each of its transactions through those different CDEs. So the CDE is really aggregating the leverage lender dollars, the investors' dollars, all go through the investment fund, and those dollars are invested into the CDE. Now the CDE begins to operate as a lender. It's now fully capitalized with the dollars between the investor and the leverage lender. So it makes a loan to the Qualic B. So you'll see two loans. One loan is what we call loan A, and the other loan is loan B. You'll notice that loan A really tracks exactly what the leverage lender loaned, $7 million. And it also tracks, to some degree, a portion of what the investor invested. The difference between the $3 million and the $2.8 million are really the fees and expenses that were necessary in order to close the transaction. And the reason we track those dollars is because when the transaction unwinds, the hard debt, the $7 million in debt, is repaid and paid back through the structure and back through to the leverage lender. The amount that is the B loan is, sometimes you probably heard these terms, forgivable, and that's kind of like shame. We really don't want to say forgivable because it has to look like and walk like debt, and it has to be a real loan at the time that we close the transaction. But some allocatees have come up with structures that allow for the loan B to be forgiven or owned by the Qualic B at the end of the 7-year period. So as I said, we don't necessarily say it's forgiven because it's not determined that it's forgiven at the time that the transaction closes. We utilize an agreement called a put-call agreement that allows for the Qualic B/borrower to purchase the ownership interest in the investment fund, thereby owning the loan B note. So I'm going to jump through to a transaction that we closed recently in Philadelphia, where the developer, we were counsel to the developer, Galaski Labs, and the developer was engaged in what is considered to be a mixed-use project. They had a restaurant, some other inline stores, a co-working space on the lower levels, and then residential apartments on the top level. It wasn't a new construction transaction. It actually was readapting an old manufacturing plant that had been dormant for many, many years. So you can see the benefit of how New Markets revitalizes communities and brings back old manufacturing plants or old facilities that have not been used in many years. So for this example, it's very similar to what we just talked about, but I wanted to show you a real transaction to help you get a better sense of it, and then to some degree add in a bit of opportunity zones so you can see how this transaction was done. So as I mentioned before, on the left-hand side where you see the Gulaski Leverage Lender, that is the affiliate of the borrower. The affiliate of the borrower received a loan from Fulton Bank. So Fulton Bank made a loan to the Gulaski Leverage Lender. Gulaski Leverage Lender then made a further loan to Twain Investment Fund. Twain Investment Fund is owned by US Bank. So if you look at the ownership between the investment fund, you can see that US Bank owns a portion, and then also another non-member manager owns a portion of Twain. That's done because US Bank typically syndicates its new market tax credit deals. So once again, if you see the dot through the structure, that's the upper tier. So it's a whole transaction that's happening before we ever get to the CDE portion of the transaction and the Qualic B portion of the transaction. But the upper tier has to happen so that the QEI can be made. So the QEI is what is made between US Bank and Twain Investment. No, I'm sorry, the QEI is made between Twain Investment and the CDE. So that's the qualified equity investment that I mentioned before that is required to push down 85% at least, substantially all, to the Qualic B, which is Gulaski Labs LP. The Qualic, which is the qualified low income investment, is what's made between PIDC as the conduit lender, that loan, which is made to Gulaski Labs. So hopefully working through and looking through this model helps to make some of the terminology that I used earlier really live a little bit. So for example, once again, I'll just reiterate it because I think sometimes it can be a little confusing, but I want to make sure that it makes a lot of sense utilizing the chart. The triangle in the middle, which is the PIDC entity, that is the CDE. That is the entity that qualified for or applied to the CDFI fund for CDE certification. The PIDC Community Capital is potentially the entity that actually received the allocation, which is the entity that received the allocation of new market tax credits. They actually applied to the CDFI fund and received the allocation, and then further sub-allocate the amount to the CDE. As you can see in the Roman numerals, just imagine how many CDEs or sub-CDEs that PIDC has had over the years as they have done multiple transactions. Then PIDC CDE New Markets is the general partner of the PIDC sub-CDE entity. So if you think about it, like we talked about before, why is everyone in the transaction? So PIDC is in the transaction because they are a community development division of the city of Philadelphia. So they have an economic development mission, but they also collect a sizable amount of fees. It's a sub-allocation fee, which is about $200,000 when this transaction was done. And then there are monitoring fees and fees that are collected over 7 years. So entities that are government agencies or government entities that are looking to further their mission can step into the role of PIDC in this example and continue to develop its mission, continue to assist communities to develop great projects, but also generate additional revenue. Why is US Bank in the transaction? As you can see, just based on pure corporate and tax law, as a partner in the PIDC limited partnership, the return is based on how much you have invested. So if you've invested 99.99%, or in this case, it's pretty much 99.98%, your return is based on that. So when PIDC, every dollar that comes into PIDC other than for fees are upstream back to Twain, and then Twain upstreams those back to US Bank. So that's how US Bank receives its tax credit benefit. That's why it's in the deal. Why is Fulton Bank in the deal? Fulton Bank is in the deal because it made a loan and is looking to receive the return on its interest and principal in the transaction. Fulton Bank at the upper tier does not have collateral at the lower tier. The lower tier collateral is between PIDC as the CDE and Gulaski Labs as the limited partner, which is the borrower. So Gulaski Labs provides a mortgage, and all of the loan documents are between Gulaski Labs and PIDC. They are not between Fulton Bank. Fulton Bank has a separate set of loan documents for its loan between Fulton Bank and Gulaski Leverage Lender. Those loans typically will have guarantees attached to them. Fulton Bank may have asked for an assignment of the leverage lender loan documents between Gulaski Leverage Lender and Twain. So I wanted to point out the difference in the collateral at the different levels, because that can be a sticking point for the lender of choice. So for developers who are looking to work on new market tax credit transactions, you want to have this conversation with your bank very early on to find out how comfortable they are with doing a new market tax credit transaction, particularly around the collateral that they'll receive. Now, just because I'm an attorney, I just can't help but to give some help to the Fulton Banks of the world or other banks. There are times where the Fulton Bank entity, just to complicate the structure a little bit more, will make a smaller loan at the project level where Gulaski Labs LP is located. You see, it's just a loan from PIDC, multiple loans, but it's just PIDC as the only lender. Well, Fulton Bank could make a smaller loan at that level so that they also receive a mortgage, but it also puts them in a little bit more parity with the project and with PIDC as the lender. They'll also enter into an intercreditor agreement, but it often makes some banks a little bit more comfortable that they have collateral at the upper tier and they have collateral at the lower tier. We don't always see that, but that is something that many banks, if they need it, many transactions will accommodate that structure. So if you take a look at what we call the Quilicky loans, so recall that the equity investment between Twain and PIDC is called a QEI, a qualified equity investment. Then the loan, we typically see more loans from the CDE, in this case it's PIDC, to Gulaski Labs, the quality or the borrower. We typically see more loans, but it could be an equity investment. Here, it's the Quilicky loans. And this chart that I'm showing you can get as complicated as 4 different CDEs. So just imagine where the triangle is with PIDC, it could be 4 different CDEs all making Quilicky loans to one borrower. So we track and trace the loans by naming them loan A, which typically is the hard debt that has to be repaid, the hard loan, which should trace right back through the structure, through PIDC as a CDE, trace back up to Twain, and then back out to Gulaski Leverage Lender, because that's essentially how the payment is made. The Gulaski Labs entity, as the borrower, makes a payment to PIDC as the CDE. PIDC distributes that cash to Twain. Twain makes its loan payment to Gulaski Leverage Lender. Then Gulaski Leverage Lender makes its loan payment to Fulton Bank. That is essentially the crux of how the leverage lender model works. The full benefit is that US Bank, who only invested 2 million, 2.7, 2.9, around that amount, is getting the tax credit benefit on the full amount of the transaction. That is the beauty of the leverage lender, leverage loan model. If you look at I'm going back down to the loan between PIDC and Gulaski Labs. CDE loan A1 is hard debt that has to be repaid back to Fulton Bank. CDE loan A2 is hard debt that has to be repaid back to Fulton Bank. But CDE loan B is that forgivable piece, or that portion that potentially could be forgivable, depending on a few different factors, but that's essentially the equity. That's the reason that the Qualic B or the borrower does this transaction. They're looking for the equity benefit that stays in the transaction. So not only are they expecting to get a 7-year interest-only loan that is below market interest, they're also expecting to have the equity stay at the borrower, with the borrower at the end of the 7-year period. And as I mentioned, in order to make that happen, there's a fair amount of transaction documents that reflect how that works. But it basically is Gulaski Labs or an affiliate of Gulaski Labs purchasing the Twain Investment Fund entity at the end of 7 years. So if the CDE owns the loan A notes, the loan B notes, step one of unwinding this transaction is loan A is repaid back up through the structure so that Fulton Bank is repaid and made whole. Then the loan B, which is still in the transaction, is held by the CDE and can be held or upstream through to the investment fund. But the investment fund is now owned by an affiliate of Gulaski Labs. That is how Gulaski Labs exits this structure and we collapse this entire new market tax credit structure. So here is just a little bit further of the sources and uses, just to really show the loan A, the loan B, and the actual equity, and then some other contributions. But then I want to zero in on the opportunity zone investor, which was equity. So opportunity zone investments are equity investments only. They're not loans. They have to be equity. Step one is the opportunity zone funds have to go and be put into an opportunity zone fund. And then that opportunity zone fund becomes an investor in the Qualic B. So at the lower tier level where you see Gulaski Labs formed a opportunity zone fund. Within that opportunity zone fund, we did a lot of really cool things in this transaction. Gulaski Labs and the owners of Gulaski Labs are very innovative in their approach to community development. They're innovative with trying to stave off gentrification. So we did a crowdfunding transaction within, it's not here, but we did a crowdfunding transaction where we were able to allow community or potential community residents to invest in the Opportunity Zone Fund or in a sister entity that was connected to our Opportunity Zone Fund. So they were able to allow investors to make an investment into an Opportunity Zone fund, and I'll get into more description about an Opportunity Zone fund shortly. I just want to explain this while we're looking at the model. And the investors made their investment into an Opportunity Zone fund, and then the Opportunity Zone fund became a limited partner in Glasky Labs. That is how the Opportunity Zone fund was able to take part in the Opportunity Zone transaction and the Opportunity Zone program. Essentially, the Glasky Labs LP is qualified Opportunity Zone property, and we'll talk about that shortly. So just jumping back to the projected sources and uses. As you see, the Opportunity Zone investor, which was equity, was $250,000. So that really gives a bit of an overview of how new market tax credits work and how the structure comes together. I'd like to just pause for a second and just see if there's any questions. And okay, good. So we don't have any questions. So hopefully I'm explaining this in a very clear manner so that it makes a lot of sense. So let's jump into opportunity zones. So opportunity zones is really the new incentive or tax credit incentive that is available to help to develop low-income communities. Once again, similar to new market tax credits, opportunity zones is a place-based community development incentive. It was enacted in December 22nd, 2017 under the Tax Cuts and Jobs Cuts changes to the Internal Revenue Code. At the time that the Opportunity Zone legislation was enacted, governors throughout the state had to designate low-income communities or low-income census tracts that they would designate as opportunity zones. That has been done. There's a fair amount of questions for people that when they find a location that they want to use, but it's not an opportunity zone, is whether that zone can be designated. At this point, all opportunity zones have been designated. There will not be any further designations. The ones that have been designated are designated for 10 years. Now, there are opportunities where there is a designated opportunity zone census tract that's adjacent to a census tract that's not an opportunity zone that has some flexibility of being utilized, but that takes a little bit further investigation. So once again, just like new market tax credits has CDEs, QualiBs, QuilicKeys, QEIs, opportunity zones has its own vernacular. Here we call it a QOF, a Qualified Opportunity Fund. A Qualified Opportunity Fund is a corporation or a partnership. LLCs are fine. At the beginning, when opportunity zones first came out, everybody struggled as to whether it could be an LLC. So you can form an LLC or a partnership or a corporation and use that as an opportunity zone fund. The fund has to self-certify on Form 8996 pursuant to the IRS regulations. The fund has to invest 90% or more of its capital as equity into qualified opportunity zone property. So if we think about the structure that we just looked at for the Glasky Labs project, Glasky Labs was the qualified opportunity zone property. And qualified opportunity zone property can be stock, can be partnership interest, which is located in an opportunity zone. And when we think about partnership interest, let's look at it two different ways. Technically, the QOF could have owned the underlying property, or the QOF could have an ownership interest in the partnership that owns the underlying property. So two different opportunities for ownership for the QOF. For the most part, I'm just going to jump back. For the most part, most of the QOFs that we've seen like to just form the fund and then invest in another entity that will ultimately own the real estate. So qualified opportunity zone business property has to be tangible property that's used in the trade or business, has to be qualified by an unrelated party. So that's a whole analysis that has to be done. as to whether the property or the real estate is or was previously owned by the owner as compared to the entity that's acquiring. So let me make this live a little bit. With the Gulaski Labs project, the Gulaski family owned the real estate, the manufacturing plant, for many, many years. Part of the deal and the agreement was the developer would allow the Gulaski family to maintain an ownership interest in the new partnership. So Gulaski Labs LP is owned a portion by the Gulaski family. So we had to do a 20% analysis to determine whether we would trigger or trip over the 20% requirement, because that would then make the project and the property not qualify opportunity zone property. So the 20% requirement is very important. Further, during the substantially all of the holding period, substantially all of the qualified opportunity zone property must be substantially owned at 70%. So 70% must be owned. The qualified opportunity zone business, similar to a Qualic B, 50% of the income must be from active conduct. 40% of the property must be used with the active conduct of the business. And then we have some of the same requirements. 5% of the unadjusted basis of the property can't be used. No more than that can be used in qualified financial property, which is debt, stock, partnership interests, options, and futures. And then the same no sin businesses. So much of the opportunity zone requirements come out of new market tax credits. So it's very, very, very similar. So one thing that we've seen is there is a large number. I mean, it's really probably close to $3 trillion in unrealized capital gains. So you're talking about a regular person that has a capital gain can participate in opportunity zones. It doesn't have to be that same complicated structure like we did with new market tax credits, where it's just banks or it's just a certain handful of banks. An individual who has a family business that sells the business or sells a building owned by its family and now has a capital gain can invest those dollars into an opportunity zone fund. So within 180 days of the capital gain event happening, you sell the building, and within 180 days, you want to find or form an opportunity zone, a QOF or opportunity zone fund to make an investment. And the benefit here is a deferral of your capital gain tax. It does not completely wipe out capital gains. In 2026, everybody will pay taxes. So if you make an investment today and you hold the investment for 5 years, it's a 10% step up in basis. If you hold the investment for 7 years, it's a 5% step up in basis. But there is a true up, a true up moment in 2026 that you pay taxes. The beauty of opportunity zones is, let's take, for example, that you made an investment in Gulaski Labs. In 10 years, the gain that you have accrued from your investment in Gulaski Labs is not taxed at all. So you have to hold for 10 years in order to fully realize the true benefits of opportunity zones. But it is not paying tax on the gain that's been accrued over the 10-year period. It's not that no taxes are paid. Taxes are definitely paid in 2026. So there's a couple of ways of forming a opportunity zone, a QOF or opportunity zone fund. As I said, it can be a corporation or a partnership. Many times we will see multiple different QOFs being formed, but a QOF is a security. So for the first 4 or 5 years of my career, I spent it representing publicly traded banks and insurance companies. and understanding and working through the securities laws. Because this is a security, you do have to make sure that it complies with the securities laws. There are exemptions in the Securities Act, but there's also state blue sky laws and the Investment Advisors Act that have to be complied with. So before forming an opportunity zone, you do want to talk with a CPA and an attorney to make sure that you're not running afoul of certain notice requirements, as well as certain filing requirements for with the SEC and your state securities regulators. So pairing new markets, I mean, sometimes that's the major question that people have. How do I pair opportunity zones with new markets? And I hate to be have a spoiler alert here, but because of just the differences in the program from a technical perspective, it creates a fair amount of complexity. And it's not that it can't be done, but very many have not been done. I don't know of very many that have been paired with opportunity zones. What we did, and we call it a side-by-side deal, not necessarily pairing. Pairing in its truest sense is being able to take the model that I showed you and basically US Bank operating as the new market tax credit equity investor would also operate as the opportunity zone investor. That's the truest sense of what I mean by pairing them together. But the side-by-side approach, which is what we did in the Golaski transaction, allowed us to form an opportunity zone fund, and where you see QUAF investors invest capital gains. So we essentially formed an opportunity zone fund and allowed our qualified investors to invest in the opportunity zone fund. And then that opportunity zone fund purchased Golaski Labs, which is the qualified opportunity zone property. So because of the complexity of pairing new markets, we typically do side-by-side deals. Let me just mention a few of the problems. Because opportunity zones is a equity-based transaction source as compared to a debt source, which is new markets, the CDE then is becoming an investor in the Qualic B. So you're looking at a CDE, think about the CDE as whether it's PIDC or City First, now becoming a partner in the developer entity. Well, if that happens, many of the expectations, the reasonable expectations that the investor has, meaning the investor that's looking for his 39% tax credit, become compromised. More importantly, the CDE or PIDC or City First as a CDE really would be changing its entire business model. Its entire business model for new market tax credits is based on a debt structure, not an equity structure. So those are some of the issues that we're confronted with in trying to pair opportunity zones and new market tax credits. That's just a few. I mean, there are many, many more, but those just kind of, are highlighting some of the big issues. So this was a wonderful opportunity to talk with you. I thank you so much for participating today. And if there's any questions, please shoot me an email or give me a call. Once again, my name is Dionne Savage, and I'm the managing partner of Savage and Associates Law Group. Thank you, and have a good day. Thank you, and have a good day.